All right, we got some great news for Alphabet stock investors as the management team elaborated on the success of several of its products. Now, I know Alphabet's stock price has failed to reach that enthusiasm from stock market investors, but the underlying fundamental performance of the business continues to improve. What's weighing over the company, what's weighing over its head, is that risk from large language models and changing consumer behavior, and maybe the stock price won't gain significantly until that risk is comfortably mitigated. So it's a patient game here for Alphabet stock market investors. Myself included, I've owned Alphabet stock since 2020, and I'm comfortable with the current risk versus reward. But let me share with you these latest details and why it's good news for Alphabet stock investors.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.
All right, so Alphabet's saying that over 2 million advertisers now use Google's AI-powered asset generation tools to run ads, which is a 50% increase from this time last year. And this makes a good point here. This is a good time to make this point here is the advantage Alphabet has over other creators of large language models is that Alphabet already has great relationships with marketers and advertisers, right? For decades, marketers and advertisers have been using Alphabet's platforms to run their ads to help support their business, the growth of their business. So with the launch of Alphabet's AI tools, they can now seamlessly integrate them with their relationship with advertisers and make it a more convenient option for marketers, right, to monetize these large language models, whereas large language models from ChatGPT and others have to find different forms of monetization, which could be more difficult to achieve. And that's why you see OpenAI continuously has to go back to investors and raise billions and billions of dollars, despite the fact that just last week they reported that they have over 700 million monthly active users or weekly active users, which is incredible growth. But the difficulty lies in monetizing those monthly active or weekly active users. And a relatively smaller percentage of those 700 million weekly active users are actually paying for the service. So it'll be interesting to see how this industry develops and how monetization changes consumption patterns from consumers. The company went on to say that in the past 12 months, YouTube ads viewed on connected TV screens drove over 1 billion conversions. We saw strong growth in retail thanks to connected TV shopping ads, which allows viewers to shop directly via QR codes shown on screen during advertisements. And in my opinion, YouTube is the best streaming service available right now. You can get the ad-free version by paying some monthly fee, or you can just watch YouTube for free if you're okay with watching advertisements every once in a while. And the amount of content on YouTube is incredible, and the amount of customized content is also incredible, right? You have content that's geared towards specific users. Not everything on YouTube is focused on a broad audience, right? Which other streaming platforms, they have to focus their content on more broad audience basis. Otherwise, that model is not successful, right? They can't be successful making content that only 1,000 people or 2,000 people might watch. But on YouTube, I'm a prime example. I make content that only a few thousand people might find interesting, right? That model would not be viable anywhere else. So YouTube makes it so that every individual finds the things that they're looking for. And personally, more often than not, YouTube is my go-to when I'm looking for something to watch. Other than if I'm trying to watch a Dodgers game, of course, I go to the Dodgers streaming app. But other than that, if I'm like trying to find something interesting to watch, I probably go on YouTube because that's the place I know I'm more confident to find something I'm interested in watching. Whereas if I go to Netflix or something else, I'm going to be looking around for a while. I might not even find anything that I find interesting to watch. But with YouTube, more often than not, I will find something. And I think more people are like me in that they're finding more things to watch on YouTube, and the growth of this is incredible. YouTube has over 2 billion monthly active users, 2 billion, whereas the latest update from the streaming leader Netflix has it at, less than 250 million subscribers. So I know it's not apples to apples because YouTube is free and Netflix you have to pay, but still YouTube is able to generate a lucrative business model by offering content for free. And that's great news for Alphabet because that's a great customer value proposition to get all of that great content for free. If you're watching some advertisements, that's a great customer value. And the customer value is one of the 6 most important things I look at when I'm evaluating the stock. As many of you have read in my book, the 6-step investing framework, the customer value proposition is one of the most important steps because that determines if customers will keep coming back to you and keep trying new products that you advance. But if you're making a product that someone spends money on and then they look back and they evaluate their spending and they say, I wasn't happy with the value I got with this money I spent here, so I'm not going to go back to that company, or I'm not going to go back to that restaurant or that electronics provider. But if you do provide a good customer value, your customers keep coming back, and that's what Alphabet provides. Alphabet provides customers with a great value proposition. All of its products are free for the most part, and consumers really like these products, and Alphabet still generates a very lucrative business, generating operating profit margins over 30% by giving customers free products. By the way, this document that I'm looking at is Alphabet's second quarter 2025 earnings call transcript, where I've highlighted the key takeaways. And I do this for hundreds of companies every quarter. And I started uploading this recently, making it available to channel members. It was an exciting new membership feature, one of my favorite new membership features I've added. You can join my channel and get access to this for less than $5 a month, as well as many other benefits. So speaking of the operating profit margin, in the most recent quarter, Alphabet's operating margin was a robust 32.4%. 32.4% by offering products that are mostly free, right? That's a very difficult business to create and maintain and sustain. Alphabet has managed that. Very few businesses in the world have managed this. Alphabet is one of them. Meta Platforms is another one. And that's about it I can think of off the top of my head for companies that offer free products and generate operating profit margins north of 30%. If I'm missing any, please feel free to let me know. But Alphabet at 32% and Meta Platforms is up over 40% are the two businesses that I know of that offer people free products and still maintain very strong businesses, revenues of a couple of $100 billion and operating margins in this category. The company saying that their operating profit margin benefited from strong revenue growth and continued efficiencies in their expense base, partially offset by a legal charge and a significant increase in depreciation expense. So the legal charge, those are often coming for Alphabet every few quarters or every few years. They're faced with a legal charge and they have to pay a fine of a few hundred million or a few billion. It's just something that you have to come to expect from Alphabet every once in a while. And then the depreciation expense is going to consistently increase in the near term because they've spent hundreds of billions of dollars building out these data centers optimized for artificial intelligence, and they spent cash on them up front. They spend $100 billion this year, but that 100 billion doesn't go in as an expense this year. That 100 billion goes as a cash outlay in the cash flow from operations line item in the cash flow statement, and then it goes into the income statement every year as a fraction of that total spending. So if they're using straight line depreciation method, if they spend $100 billion this year and they expect these assets to last for 10 years, then they'll take a $10 billion depreciation expense every year for 10 years. That's how capital expenditures work their way into the income statement, and the company has spent a lot and will continue to spend on these capital expenditures. But that's good news because the company generates great returns on invested capital. So I like to see when a company like Alphabet that has a history of generating good ROIC to invest more money, because that tells me they found the category to make investments. And I'm excited about that because it's difficult for a company of its size to find new areas for growth. And the fact that they found this area for growth is exciting for Alphabet stock investors. Hey everyone, so many of you have been asking about my investing strategy, and I'm excited to announce that I've written a book that's available for sale now that describes my 6-step investing framework for evaluating stocks. I've added the link in the description below.